In this video, I will show you 3 undervalued stocks to buy in January 2025. I own 2 of these 3 stocks, so obviously I will be biased, but I think these are great buying opportunities at the moment, and I think if you buy them right now, you will make a lot of money in the coming quarters, coming years. That's my opinion, but just so you know, I own 2 out of these 3. In case you are new to this YouTube channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade, and I have achieved a performance of 25% per year. So I think that the performance will continue thanks to these names. Now let me start with the security company in the US called Napco Security Technologies. Maybe you are familiar with the name. This is a small cap. The market cap is $1 billion, right? And if you look at the stock right now, it's quite volatile. If you look at the past 3 years, it's quite volatile. It's quite volatile because the company is attacked. It's attacked by short sellers. In 2023, there were rumors that they had an accounting issue. So, okay, very well. The company dismissed all the investment, all the accusations, and the stock rebounded very sharply. Now there was a second short attack against the stock about same thing, accounting issue. So the company was very clear, saying, okay, we've made some restatements here and there. We will hire Deloitte, the audit company, one of the big 4, so that everything is clear. So if the company was a fraud, they would not hire Deloitte. It's not like super micro and the scandal we had a couple of weeks ago. Now Napco has no accounting problem. They hired a big auditor and they did some restatements here and there. Now what is Napco? So now I explain why the stock is volatile, and I think that the stock right now is very cheap at the moment. So let me scroll down a little bit. I'm on the website called Guru Focus, and let me show you what they do and the financials. So you have a clear picture. I will show you the valuation so you know at the end of this video if you want to dig deeper or not. Napco Security Technologies manufactures security products encompassing access control systems, door locking products, intrusion and fire alarm systems, and video surveillance products. Very simple. Its products are used for various applications, which includes alarm systems like automatic communicators, combination control panels, digital communicators, and digital keypad systems, fire alarm control panel, and area detectors, mainly used for commercial, mostly commercial. So real estate or stores. This is not for residential, not for your house, my house. 80% of the revenue from Napco comes from commercial. This is their biggest market. So it's a B2B business. Okay, so commercial, some of the revenue is coming from residential and some institutional, industrial and government uses, but mostly commercial, okay? Geographically, the company derives a majority of its revenue from the US. Yeah, I'd say more than 95% of the revenue comes from the US. Okay, very well. Let me check some things. Now let's talk about the margins of the business. You may think that this is a company selling hardware. Yes, half of the company is selling hardware, so apparels, equipment, at a 20% margin, okay? And now half of the company is a software recurring business with 90% margins. So over the past few years, the share of the software increased drastically and the overall margins of the business increased, and they have no plan of stopping here. The company was very clear. They want to grow double digits their high margin recurring software segment. So I have a high conviction that all the margins you see here, gross margins 50%, operating margins 30%, net margin 25%, all these margins will go up progressively for future years. So that's why I said I think these companies will make much more money over the coming years. So this is not a short-term story here. We are talking at least 3 years, 4 years, 5 years, and they will make a lot of money. So much money that now that they have paid off all their debt and they need to reward shareholders. So they just started a dividend so they use the excess cash to reward the shareholders. So the company has a lot of money, a lot of margins, and the margins will continue to increase. This is very, very likely. Okay, let me show you some stats. They started their recurring high margin software in, let's say, circa 2017, and it became a larger part of the pile as it grew, and now it's more than 40% of the pile. If you look at the revenue growth, everything accelerated since the high recurring high margin segment that took a bigger part of the revenue. Same thing for the net income. Stable, and boom, complete explosion because of this high margin recurring segment. About the debt, look at this. This is the debt and the cash. Debt in red, you see that prior to 2017, the company had more debt than cash, and now they used all the cash to repay their debt, and now they have almost no debt, and they are flushed with cash. This is a very good situation to be in. You can do whatever you want with the cash. You can reinvest inside your business. You can pay dividends. You can do buybacks. In the latest quarters, they did a buyback. They started a buyback because the stock is cheap at the moment. And same thing for the free cash flow, right? Free cash flow, you need some investment, some capex, inventory here and there, but we follow the same trajectory as net income. Free cash flow at all-time highs. And the ROIC, the return on invested capital, that shows efficiency for the business, you see, quite stable, around 10%. And now, with the new avenue, high recurring, high software, high margin business, the ROIC is increasing a lot. 20% per year, and then the ROIC was 30%, now it's 50%. The efficiency of the business is likely to continue increasing over the coming years. So this is very, very interesting. So I said, what do they do with the cash? Now they could pay off the debt, they reinvest in the business, they did some buybacks in the past, and in the latest quarter, look at the quarterly measures, they initiated a buyback, like $7 million of buyback, so that's 0.5% of the shares. There is a rumor that the company will use most of the cash to do dividends and buybacks because, you can only invest a small sum of money in the software business. So they started the buyback program. They announced a new buyback program of 1 million shares. So I think they will continue to do buybacks actually. And what about the dividends? You see the cash flow from dividends here in purple here. And there is a mistake here in the accounting cash flow statement balance sheet. I'm telling you, they continue to stop buyback. What you see here, the blank, is kind of false. It's a delayed by dividend, but don't worry. So in 2023, they had so much cash they didn't know what to do with the cash. They started a dividend that is increasing year over year, and they started some buybacks. So now the business is at a good stage of its growth. They are growing nicely. The recurring business model is growing like 20% per year, 30% per year. So the global margins for the business are very likely to continue. They have so much cash they don't know what to do inside the business. This is a software high recurring business that doesn't need a lot of capex. So the free cash flow is really high. If you look at the conversion between net income and free cash flow, here you see you have a cash flow conversion very, very high. Most of the free cash flow, most of the net income is translated into free cash flow. So yeah, you are talking about a free cash flow margin of 25%. That is very good. That is very healthy. The ROIC of the company is increasing. And what is the valuation for this one? PE ratio of 25. It's lower than the S&P 500, right now trading at a PE ratio of 30. So you have a company trading at a discount, but I think the company is better than average, better than the average company in the S&P 500. The price to free cash flow follows the same step between 25 and 30. You get my point. If the company continues to grow like this, high margins, dividends, buybacks, this is very likely that shareholders will be insanely rich. You have a dividend yield of 1%, so this adds some safety, and that's good. And if you want the bear case, Well, I mean, this is a video of stocks to buy, but let me get the full story here since you are here. In case you want to go deeper, the bear arguments, if you want to continue the due diligence here, is one, check the accounting fraud, check the short report from Fuzzy Panda here and the allegations. This is very interesting to see how the business model works. Second, they manufacture components from China and they build the hardware in Dominican Republic and they shift everything, so you can understand how it works. It's very efficient actually. And three, you will understand the capex that is very low for the business model. You can also understand the residential segment if they have some opportunity with the new segment, with the new product they are currently selling, and that's very interesting. Very interesting. You have some growth story here. An additional thing that can be added to the bear case maybe is that the CEO and CFO are quite certain age, like above 70 years old. So maybe they will have to leave the ship someday and they are selling some shares. So you have insider selling of the shares. Most of the time, this is a yellow flag, not a red flag, but a yellow flag. But since they are 77 years old, I think this is normal. This is not a major red flag here, but something to monitor over the years. Okay, so now that was for the first stock. You have the story, you have the investment case. I think it will grow profitably and the margins will be sky high in 3 years. That's my opinion. And let me tell you about the second stock. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. The second stock is Evolution AB. Evolution AB is a company that I own. Okay, that's around 10 or 12% of my portfolio. Evolution AB. Oh, that's strange. I can't. Okay, and they do games for online gambling, right? This is a Swedish company. The market cap is $15 billion approximately, and there was a lot of hype in the business in 2021, and the stock was trading at a PE ratio of 70, and now the stock went nowhere for 4 years. But while the stock went nowhere, the earnings, the revenue, the cash flow continued to go higher. More revenue, this is in blue. More net income, this is in green. More free cash flow, look at this in blue. More dividends. The return on invested capital is 30%. They have no debt. They have a lot of cash. Dividend yield is around 4%. And the PE ratio for this fantastic business with exponential charts, curves, the PE ratio is 12, 13. So quite cheap. You have a discount. And we are talking about a company that makes games, so very efficient, asset light. The margins are very high, operating margins of 60%, net margins of 60%, very high efficiency, highly efficient. But why is the stock going nowhere? It's because you start from a very high point, a PE ratio of 70. So obviously you have a reversion to the mean. And now it seems like people are hating this stock because it went nowhere. Sometimes the market is irrational. You have some worries. We are talking about the gambling market, so it's not for everybody. Definitely not for everybody. You have some regulation issues. I made some videos in my YouTube channel in case you want to know more about Evolution. You have some competition that is far behind, but the competition is still growing. You have some regulation issues. You have some strikes and their employers, some unions. They had to fire some. You had to fire some employee in Georgia. They developed new studios. Now they want to develop their gambling industry in the US, and the US is less profitable compared to Europe or Asia. So okay, maybe people are anticipating that the margins will drop, and I agree with them. The margins can drop. We will go from an operating margin of 60% to maybe 50%. Will this change the investment thesis? I don't think so. I don't think at all. The business is very cheap and everybody is scared right now. You had a recent report from the UK regulation talking about identifying illegal markets, illicit markets, but Evolution was very cooperative, and I don't think this will be a major issue. And now, because of fear, panic, uncertainty, the PE ratio is 13. So quite cheap compared to the market. I think this is a fantastic buying opportunity for the market. I'm a shareholder of this one, so obviously I'm biased. Please do your own due diligence. And the third one for you is a company maybe you're not familiar with. It's a small company in Korea. Oh, interesting. This is $500 million of market cap. $400 million of market cap. Small company in Korea. What do? They do online games, mobile games. Very simple. That's the end of this investment thesis. Because this is an online gaming company for mobile in Korea, they have high margins, gross margins of 40%, operating margins 20%, net margin 15%. That's fine. That's a gaming company. And if you look at the growth, you see here that they went mobile in 2017. So before going mobile in the past, they were unprofitable. And now they shifted their business model to mobile gaming, and now it became profitable again. And now you build the cash, and now you have some strong cash flow, and now you are efficient with a very high return on invested capital. Okay, so if you look at the latest data when it comes to the balance sheet, you will see that they have almost $400 million in cash. And what did I tell you 2 minutes ago? I told you that the market cap is $400 million. So the company is selling almost at cash. 90% of the market cap is in cash. And before you panic buy into this stock, let me remind you that this is a Korean company. If this company was traded in the US with 90% of the market cap in cash, people would buy it. They would say it's safe, profitable, that's fine. But take this with a pinch of salt. That's a Korean company. So they don't have the same capital allocation that people in the US, in the Western world have. They don't plan to do dividends. There is no dividend. There is no buyback. And the cash is sitting here in the balance sheet. But how I see the situation is that the cash, I have checked the latest data for the past 20 years. The cash is used as a cushion, like as a psychological threshold when the company can't go under, basically. So if we say that the cash of the company in the balance sheet is $400 million, it's very unlikely, that would be my guess, it's very unlikely that the market cap drops below $400 million. So you have a psychological threshold here, and you can only go up from there. Basically, that's the story. I am a shareholder of Gravity. I bought it in summer 2024 at around these levels, and now the stock is back at this level. It increased a little bit from $60 to $68, and now we are back at $62. It's traded in the US stock market, New York Stock Exchange, so it's available on your broker. And I think this is a very simple, compelling opportunity. And the correlation, I will leave this video with that, with an additional tip. The best way to see if the company will explode, you see here you have a lot of volatility. Every time the company delivered a huge game, a very successful mobile game, the stock went up massively. You see here in 2017, they tapped into a new market, massive explosion of earnings and the stock price. Same thing for 2019, same thing for 2020. And in 2020, the stock went from $30 to $200. That's a 6x, a 7x in 1 year or 2 years. So it can go up really fast. I'm a shareholder of this company because I'm sitting here with a lot of cash, waiting for the catalyst, waiting for a new successful game. So I see this as a very, very appealing, very attractive risk-reward scenario. You are here with your cash. The company can't go much lower than this, so you have a safety net. And in case the games are complete flop, that's fine. As you see here, they still deliver some net income. So net income that is translated directly into cash in the balance sheet. And in case you have a very successful game, the stock is a easy double, easy triple at this point. So this is what I see in Gravity. I think it's one of the most attractive risk reward in the current market. Now the current market is quite expensive. The S&P 500 is quite expensive. So these three companies can deliver very good returns this year and in the coming years. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address, just click the first link in the description and I'll see you on the other side.